Hey, what's good? It's your boy Matthew Michael. In today's video, we're going to be talking about credit spreads. If you're new here, please be sure to subscribe and hit the bell notification icon so that you don't miss any future content or giveaways. I post a new one of these every week, so don't miss out. Also, be sure to smash the like button because I work hard on these videos. And it's all that I ask. If you would like to get 2 free stocks valued up to $1,400 just for signing up for Webull, there's a link down below in the description. And one last thing I promise before we get into the video. I'm just going to leave my Instagram right here and you do whatever you want with it. But without further ado, let's get into the video. So here we are. Credit spreads. A credit spread is created by selling an option and then buying an option further out from the strike price than the first, resulting in a net credit to your account. Now there are a few reasons that people trade credit spreads. The first one being they want to increase their odds of success. Buying simple calls and puts just don't do it. The stock market goes up and down, and options represent 100 shares of a stock, so it's a very high risk just trading a naked call or a naked put. So credit spreads offer a range and a much higher probability of success. Another reason someone might trade a credit spread is because they're bullish on the stock. Them being bullish on the stock going hand in hand with wanting a higher probability, these are things that would lead them to trade a credit spread. But on the other hand, to being bullish, they could also be bearish on the stock and want a high probability. So the good thing about credit spreads is they go both ways, just like calls and puts. And along with that higher probability of success, they also offer a limited loss potential. And I'll show you how to find this potential later on in this video. So to start off, we're going to look at a call credit spread, which is also known as a bear call spread. And it's called a bear call spread because you're bearish because you're hoping that the stock price goes down. And if the stock price remains below both of your strike prices, you receive all your profits. That's right, as long as both calls expire at the money, you get all your money. That's right, as long as both calls expire worthless, you get to keep all your money. So first, I want to hop in Robinhood and let's take a look at how we construct a bear call spread. Okay, so we're here in the handy dandy Robinhood and we're going to be taking a look at how to build a call credit spread. Okay, so first we're going to pick out a company and we're going to use Microsoft. So trade options. We're just going to do it for this Friday. Okay, so if I just really thought that Microsoft was going way back down, I could sell. Oh wait, let me hit select. If I just really thought that Microsoft was going way back down, I'd hit sell. I would then pick a strike and I would sell the 175 and then say I wanted to buy the 180. Okay, and from this, as you can see, I will get a $4.42 credit. We review, it says I need another $3.61 in order to make this trade for collateral, but I'll show you how that works in a moment on the options profit calculator. So now that you saw how to build a bear call spread in Robinhood, we're gonna hop over to the options profit calculator and we're going to take a look at how to calculate profits, how to calculate losses, and just take a look at how movement of the stock price overall affects the credit spread. Okay, so we're here in the options profit calculator. We're going to run the exact same credit spread that we just pulled up in Robinhood. Okay, so we're going to do Microsoft. Okay, and then we're buying a 175. And we were selling a 180. And as you can see, we're back at this. Oh look. Oh. Let's flip that around. Okay, so we got that all fixed now. We're selling the 175 call, we're buying the 180 call, and we're getting money to our account. This will be a $4.42 net credit or $442 overall. So I'm going to show you this 2 different ways. This is the way that's easiest for me to understand it when I'm looking at this. This is basically a chart of the days and where it needs to be for you to realize profits for this contract. So with this credit spread, if you purchased it today, this basically shows how the stock price affects the credit spread throughout the remainder of its lifetime. So as you can see right here, at the current stock price, it's at $184. So as of right here, if nothing changed, if it doesn't go down like you thought it would, you would lose $42, and all the way up to, if it doesn't go down at all, you would end up losing $58 on expiration. If it only goes down to 83 on expiration, so right here your maximum loss is $58. And if this gets down to $179, you will begin to see profits. On the first day you'll see $98 profit. If it remains there, it's 92. All the way up to expiration, If it doesn't go down any further, fire, and you'll have profited $42. The further away it gets from the strike prices, the more profits you'll see. And as you can see, once you get under that strike price of the closest call, you are receiving the full profits. Now when it comes to calculating your max loss, how you're going to do this is you're going to take your credit, which is $4.42, then you're going to take the width of the spread, which is $5, and you're going to subtract. Here, let me get the calculator up. To calculate your max loss, you're going to take the width of the spreads, which is $5. We're going to use 500 because an options contract represents 500 shares of stock, and then we're going to subtract $4.42, which is the price we paid, and we get $58. So the max amount of money that you can lose on this is $58. Not too bad, not too bad at all. So yeah, that's the power of a call credit spread. Now let's take a look at a put credit spread. Now to talk about credit spreads, or another name for them is bull put spreads. And this works just the opposite of the bear call spread. When you think the market's going up when you're bullish on the stock, and the exact same way that you want the calls for the call credit spread to expire worthless, you want these puts for this put credit spread to expire worthless, so that you're able to keep all the premium. So let's hop back in Robinhood so we can create a put credit. Okay, so we're back in the Microsoft options chain, back on the same day and everything. We got rid of the call credit spread. So now let's purchase a put credit spread. So let's say we think the price is going up. Let's say we think it's going to go up to 190. So we're going to sell a put for 187, and then we're going to buy this 171 put. And one thing that you may notice from this spread is it was looking like a much better deal. Okay, because the total credit that we get for this one is 282, and the total credit that we got for the other one was 442. The spread's the exact same. One thing that may have affected that is both of the options were in the money with the last one. So that's one thing. Or it could also be that the probability is just higher on this one. Those are just a couple factors that it could be. But anyways, you see how we constructed the put credit spread. Now let's hop back into the options profit calculator and see how it's affected. Okay, so we're back here in the options profit calculator, and I need to make a couple adjustments. Okay, so this time, let me look at my Robinhood real quick to make it exactly the same. Okay, so this time we're selling a 187 put. Okay, so puts are on this side. 187. Okay, 187.5. Okay, and then we're buying the 182.5. Okay, 182.5. And as you can see, we ended up with the same net credit that we had on Robinhood. So now if we hit calculate, you can see that the red and the green is flipped because we flipped from bearish to bullish, from call credit spread to put credit spread. So yeah, just like the first time, you can see as the days go on, once we get just outside of the strike prices, our maximum profit can be realized at expiration. And as you can see here, our max loss potential is much higher. So yeah, this right here, for those of you who don't know, is the optionsprofitcalculator.com. Yeah, it's really helpful when you're learning how to construct options and all that. And just want to take the time to show y'all one more time, just to reinforce this, because practice makes perfect. In order to find the maximum loss, aside from using the profit calculator, you take the width of the spread, which is $5, and where we got the 5 is we subtracted the 187.50 minus 182.50. Okay, so 500 or $5, and then you subtract the credit, which is 282 minus 282 equals 218. Okay, so if you take a look down here, you'll see that 218 is your maximum loss. So that is how you figure that out in the options profit calculator. And there you have it. That is a very basic intro to credit spreads. In this video, you learned about call credit spreads, you learned about bull credit spreads, you learned how to calculate your maximum loss, and you got another tool in your arsenal. So if you enjoyed this video, please be sure to give this video a big thumbs up. Give it 2, but please don't unlike the video when you're doing the second one. Maybe hit 1 on YouTube, and then just give 1 to your screen. And then if you have any questions or comments, please comment down below, or feel free to DM me at Matthew Michael Money. And if for some reason you made it this far in the video and you're not subscribed, please be sure to subscribe and hit the bell notification icon so that you don't miss any future content or giveaways. Or yeah, just videos such as these. I think they're really helpful. I hope you think they're really helpfful. If you didn't find it helpful, please let me know down below in the comments. And if you let me know down below in the comments, try not to sound like a hater. Please try not to sound like a hater, because nobody likes a hater. But anyways, thank you so much for watching, and peace.